Pro Tax Accountant is a leading UK firm advising businesses on high-level tax planning and compliance. Imagine a mid-sized UK production company that has just greenlit a new £5 million project. The legacy financial models they previously used to calculate their return on investment are now obsolete. Between 2024 and 2027, the UK government is phasing out the old film tax relief, or FTR, and replacing it with the audio-visual expenditure credit, known as AVEC. Structurally, AVEC is an above-the-line taxable credit. Instead of merely reducing a company's taxable profit like the legacy system, AVEC provides a direct credit calculated as a percentage of qualifying expenditure, which is then subjected to corporation tax. For UK businesses of all sizes, miscalculating this transition guarantees massive capital leakage and significant delays in receiving tax returns. The UK government designed this transition to align domestic incentives with international fiscal standards. The primary catalyst for this shift was the OECD's Pillar 2 framework. The Organization for Economic Cooperation and Development, or OECD, sets international tax guidelines, and Pillar 2 established a global minimum tax rate that forced local production incentives to become standardized, transparent credits. By treating the expenditure credit as taxable income above the line, the relief remains a predictable benefit that avoids being neutralized by these new global minimum top-up taxes. To understand how to apply this, we will deconstruct the mechanics of AVEC, map the practical implications for different scales of production, and identify the compliance traps that trigger claim rejections. Mastering this new architectural framework is a necessary survival requirement for creative directors and producers operating in the UK. Let's examine the mechanics using our first business archetype, an established production company working on a standard film or high-end television project. This financial waterfall chart outlines the new baseline. We start with £1 million of qualifying UK core spend for an established entity. Under AVEC rules, a 34% rate applies to this expenditure, generating a gross credit of £340,000. As a taxable credit, this gross amount is added to profits, triggering corporation tax. Deducting the 25% tax from the £340,000 credit removes £85,000. This leaves a net benefit of £255,000, or 25.5% of qualifying spend. By comparison, the legacy film tax relief system provided a net rebate of exactly 25%. While the math is structured differently, the baseline AVEC increases the ultimate cash yield for standard productions by 0.5%, assuming the expenditure is categorized correctly. Our second business archetype is the SME, or small to medium enterprise, producing an independent film. These companies can access the Independent Film Tax Credit, or IFTC. To qualify financially for this enhanced rate, the film's total core expenditure must remain strictly under £23.5 million. Creatively, the film must pass a specific test administered by the British Film Institute. The BFI regulates cultural eligibility, requiring the project to have a UK director, a UK writer, or official co-production status. This budget dashboard displays the impact of the IFTC on our £1 million baseline. If a budget threatens to exceed $15 million through back-end participations or overages, the company must decide to cap their IFTC claim at £6.36 million, or switch back to the standard 34% AVEC rate. Securing this cash advantage requires early-stage budget policing to ensure the production does not age out of eligibility. A common misconception across all production scales is the assumption that every pound spent within the United Kingdom automatically qualifies for relief. Eligible expenditure is strictly limited to core costs. These include pre-production, principal photography, and post-production. Development, financing, and marketing are explicitly excluded. This pie chart segments a production budget into UK and non-UK costs. The red line marks the 80% cap on total core costs. Even if 100% of activities are in the UK, 20% of core costs remain ineligible. There is a major exception to this rule for UK visual effects, or VFX costs, incurred after January 1, 2025. These specific VFX costs are entirely exempt from the 80% cap limit, receiving an uplifted gross credit rate of 39%. Strategically allocating visual effects work to UK-based studios allows established companies to bypass standard limits and boost their total financial return. Our final archetype is a startup production company that relies heavily on independent contractors and loan-out companies to staff its projects. The transition to AVEC introduces rigorous administrative requirements, and the consequences of failing to meet them are severe. Companies are now required to submit an additional information form, or AIF, before filing their company tax return. The AIF is a mandatory digital evidence packet. Submitting a tax return without a prior AIF results in instant rejection of the claim. The most dangerous compliance trap within the AIF is the mandatory disclosure of connected party transactions. A connected party transaction occurs when a production company pays a subsidiary, a sister company within the same corporate group, or a contractor owned by the same individuals. HM Revenue and Customs requires these specific transactions to be explicitly detailed and financially justified at a standard arm's-length market value. To prevent audits, accounting teams must meticulously flag connected parties within their ledgers from day one of pre-production. Administrative failure is treated with the exact same severity as financial failure. Transparent accounting is as critical to a film's success as the shoot itself. Let's review our three archetypes: the established firm, the SME, and the startup. These three archetype dashboards illustrate the maximized tax yields available when the standard AVEC, the independent film tax credit, and the VFX uplifts are applied correctly alongside pristine reporting. Realizing the maximum financial yield from these creative reliefs requires precise financial architecture and proactive cost segmentation from the exact moment a project is greenlit. The information provided in this video is for educational purposes. Tax laws are subject to change, and you must consult a qualified professional before making financial decisions for your production. Pro Tax Accountant is a specialized firm equipped to guide UK creative businesses through these exact regulatory intricacies. Contact Pro Tax Accountant today for advice tailored specifically to your production budget and structural scale. The UK tax landscape is complex, but the right expert guidance turns that complexity into a reliable source of production profit.